Hello and welcome to another episode of FinTech Focus TV with me, Toby. Today we have a returner to the show. Rupak, how are you?
Thank you for having me back. I'm honoured.
It's been a while. I was trying to work out how long it was, probably about 2-3 years since you last on board. In a slightly different guise that time, where you
I was hustling in a different way, but still hustling.
And I wanted to get you back on because over the last couple of months, weeks, years, I've seen a load of the content you put out, and Rupak's Substack is now out and about, and very, very readable. I mean, there's always a great topic. We've seen you all over the Financial Times, the Sunday Times. Always like my Sunday afternoon or Sunday mornings and looking through the paper and seeing your face smiling back at me.
Well, so hope that's pleasurable.
It's been wonderful to see. So when I've seen this and been reading it, there's loads I want to dive into. So I'm really thrilled to have you back in here today. But for those who've been missing out on this and not followed the journey since last year on the show, tell us a little bit about yourself and give us the background.
So my background is actually, for my sins, the first job I ever had was actually creating content. So I was an equity research sell-side analyst. And I spent a decade analyzing financial stocks, banks, asset managers, exchanges, and hedge funds. One of the first companies I ever covered was Man Group, which was 20 years plus ago, one of the biggest hedge funds in Europe or the world. AHL was in its pomp, which is the big trend-following hedge fund that Man Group had. I covered the exchange space for a decade. And one day I asked one of the CEOs of one of the companies I cover for a job, and his name was Michael Spencer. He's the founder and CEO of ICAP. So I worked for him for almost a decade as his head of corporate strategy, running strategy, M&A, speaking to shareholders, a variety of different functions. Great ride, a really tough time for us in the market because we had a lot of disruption. But you saw businesses and industries evolve through that change, and that was very fascinating. You had Dodd-Frank and all sorts of other regulation happening. And then we were lucky enough to sell the business in 2 transactions. We sold the voice business. It's almost a decade ago now. It feels like yesterday, but that was a tough negotiation. And at that time, there weren't many buyers of voice broking assets. As you know, there was a lot of pressure on the voice broking industry and trading in general. And then we sold the electronic assets to the Chicago Mercantile Exchange. And stayed on for a year as part of the integration. And then the last time we met, I was at a startup, at Galatics, a credit analytics startup as COO. And that was a great experience because I got my hands dirty and got to see the fintech world on the other side as opposed to being in a larger space.
Such a difference, isn't it?
Completely different. You see it all, and obviously you see outside all these startups talking about the PR and how great everything is, but inside it's a different experience when you're hustling. And now I'm hustling again in a portfolio career, but one of the things I do, and I've launched last year, is a Substack. Originally called it Rupak Substack because there aren't many people called Rupak in the world. That's the first time it's been an advantage, I think, for me. Caused a bit of bullying when I was at school, but I realized that was potential differentiation. But I also didn't know.
The man of you.
I didn't know what I was going to write about, Toby, to be honest. I knew that obviously you write about stuff you're interested in. And you write about stuff you know about.
And this was originally to sort of boost the portfolio career and
this was
provide conversation.
Well, I was doing a lot in the media. I was writing a bit for a bunch of different newspapers. I've written about 30, 40 times for a magazine called IFR, International Financing Review, very, very deep in the banks in DCM, ECM. So I've written pretty much every other week for them for the last 2 years. I've done some stuff for the FT and the Times you mentioned. So it's sort of, there's synergies between the content. Obviously, the audiences are different. The Sunday Times is the most generalist audience. The FT gets a bit more technical. IFR gets a little bit more specific. The great thing with Substack, I thought, is it's a blank canvas.
You can be you.
You can be you. You can write 3,000 words on a topic rather than get stopped out after 600 words. And you can go into an angle that you may not fit with a specific publication. So it's been great, and I knew I was going to write about market structure because that's what I've done for 25 years, exchanges and so forth. And I knew I would write about the asset management and banking sector. But I also write the odd piece about things that I feel like having a rant about. That's a great thing also with Substack is, for example, late last year I was just frustrated with the amount of year ahead reviews. So the Wall Street produces thousands or millions of pages of year ahead reviews. What's 2025 outlook going to be? And you have all these analysts at different firms creating thousands of pages of documents, and none of them have a clue, basically. So I had a rant over a few weeks about that in my Substack. So again, by calling it Rupak Substack rather than Hedge Fund Weekly or whatever, I have some optionality.
And that's what it's become, as you said, you mentioned the Hedge Fund Weekly. There's been a lot of content recently, and as we were talking about before, the hedge funds have sort of really immersed themselves in or the people within the hedge funds have immersed themselves in what you're writing about. So I know a lot of it is coming there, but give us a sort of broad overview. If you were to say Rupak Substack is ... Give us the overview
I think
of what
it's
you
hedge funds, market structure, and fintech.
Yeah.
So if you look at alternative investing, I don't really write about private equity. I wrote a piece about Partners Group because I IPO'd the company 20 years ago and spent a lot of time with the founders. But I don't really have an angle with private equity. I mean, I love reading about private equity, and it's a fantastic industry, and there are lots of critiques of it that are fantastic about the structure of the industry. But I don't know it as well as the hedge fund industry. I don't have industry contacts. I haven't IPO'd those companies. I haven't analyzed those companies as an analyst, as a client, and so forth. Whereas with the hedge fund and the trading space, and I call it more than the hedge funds, I've written extensively about Jane Street. One of the viral pieces a couple of weeks ago was about a company called HRT, Hudson River Trading. And that's a firm that's very large, but not very well known. Citadel Securities, that whole HFT trading firm space.
Absolutely.
I included that in the hedge fund space. And I know that space also very well because they were clients of mine at ICAP for a decade. They were the biggest clients of traders on things like BrokerTech and EBS and so forth. And that industry is going through massive changes. It's not the day of there's 5 guys in a room running a hedge fund. I think I said to someone, I think it was someone of the Sunday Times the other day, guess how many employees there are at Millennium? And I said 6,000. And they were like, a hedge fund with 6,000 employees? They're like, that's bigger than an investment bank. So, Jane Street is annualizing at $40 billion of revenue at the moment. They just printed a $10 billion revenue quarter. So it's a space I know about. It's a space there's a lot going on about. And so hence there's been a lot more focus on the Substack in that area recently.
So let's talk about that. Let's dive into that. As I said, look, there's been a lot of articles that have gone into there. You've gone into analysis on certain businesses, within the space. You've released something today about Brevin Howard as a for example, or certainly in the last couple of days.
This morning, just for you.
There you go.
Just for you, especially because I knew I was going to come on this show.
So come in and give us your overview of what's happening in the space there, and some of the things you and your readers have been interested in.
Well, the private equity space obviously has been an asset gathering machine. They've grown assets so significantly from 3 trillion to 10 trillion private markets. And within that private markets, the venture capital space is very noisy. Venture capitalists spend more time on their podcasts and on Twitter than they do actually running money. So you've had a lot of asset growth there.
Over the last couple of years.
The last 5-6 years, you've got. So the private markets, I think, the hedge fund industry less so. And then people look at the headlines and say, well, what's going on there? Because AUM hasn't really grown dramatically like it has for the private equity space. And hedge fund managers, with the exception of maybe Mr. Ackman and a few others, they don't go on TV all the time and talk their book. And
it's always nicely secretive, isn't it?
It's nicely secretive and so forth. But behind the scenes, what you were seeing is the industry was growing. So headcount in the industry had grown massively. And that's because you saw equity long short fund with 30 billion is disappearing that was run with 10 guys running it. Instead, you've got a $30 billion pod shop starting there with 2,000 employees. So the number of employees in the industry is rising. The amount of trading they do has risen massively because those pod shops, those multi-strategy hedge funds tend to be more down the day trading or trading frequently than the more long-term hedge funds, the sort of Tiger Cubs, Lone Pines of the world. And then leverage has risen significantly in the industry as well. So although the AUM numbers may look like they've not grown like private markets, but if you've got a multi-strat in there levered 10 times rather than an equity long short that's 2 times, that's a lot more leverage and a lot more actual deployed capital.
Absolutely.
And I was seeing it on the other side because I was writing a lot for IFR in particular, but also other papers about the growth of prime brokerage in the banks. So the banks had obviously shifted away from proprietary trading after Dodd-Frank to a customer flow business. But then financing has grown in the last 5-6 years massively. So Goldman, obviously, it's an oligopoly. Goldman and Morgan Stanley and JP Morgan dominate that market, but others have tried to copy them and expand. So, the last quarter, for example, 30% of revenues in the markets business at most of the tier 1 banks is financing. It's financing hedge funds. And as those hedge funds get bigger, use more leverage, and it's not just financing hedge funds, it's financing firms like Jane Street. who are kind of, I call them frenemies, because in some ways they're eating the lunch of the banks,
Yeah.
because they're competing with the banks in some products, and in other products they're being clients of the banks.
Yeah, exactly.
So in terms of financing.
Yeah. I mean, it's a really interesting piece, that, isn't it? And I guess every time that if you look at the major institutional banks, every time there's a threat that comes towards them, it's an embrace. And think of fintech in its truest form. 15, 20 years ago, fintech was there to challenge the banks and to ultimately take them out. Was this the end of banking as we know it?
Yeah.
It adopted and became incubators and sort of grew fintechs and acquired fintechs and moved there. You could probably argue the same for digital assets and how that's become a lot more tradfied over time as well. So this is quite an interesting conundrum as we're talking about this as well, where you talk about, right, we're eating our lunch, but also how can we make sure we get the most out of it at the same sort of time? Slightly different, but
we saw it, and you and I have followed this space for a long time, and I just think back on my ICAP days, you saw it with electronic trading.
Yeah, absolutely.
Because that obviously crushed the margins of banks.
Yeah.
Banks like to come to the central limit order book because that's where you offset risk.
Yeah.
But connecting with customers, they want to do that on the phone with their customer, and they want to keep the spreads wide. But if the customer is coming through the liquidity, coming through Market Access or TradeWeb or whatever that FXall or CurrentX, whatever that platform is, they got to be where the customer is.
Yeah.
I mean, the banks have. I still remember, old enough to remember when banks have tried to kill Bloomberg. I mean, that's how. Symphony started, if you remember. And initially, and the banks had so many, Ghose trying to kill Bloomberg, and the amount of shouting and screaming. But at the end of the day, the traders of the banks want to be on there, and the salespeople, because their clients are on there.
Yeah.
And you have that network effect.
Absolutely. So let's look at this, the whole world, that hedge fund world at the moment, and the sort of the collateral around it, the adjacent sort of
trading firms. Yeah.
So if we're looking there and we're saying where you think the winners are coming from at the moment, who are the winners right now, and what do you think they're doing differently from the crowd?
So the winners within the hedge fund space is you have seen the pod shops and the multi-strategy funds win. So within a $3 trillion industry, the pod shops were only 10% of the industry, but they've grown to 15, 20% of the industry. And they're a segment of the multi-strategy environment. So the multi-strategy space was firms like D.E. Shaw, firms like Brevin Howard, firms like Marshall Wace, firms that aren't just one portfolio manager and one trading strategy, multi-strategy funds. The difference in a pod shop and a multi-strategy is a pod shop being you could argue a segment of the multi-strategy space is the multi-strategies still tend to be a little bit centralized in the sense that there are a couple of big funds and they're all trading into that big fund. You have different portfolio managers and they get allocations to that fund. The pod shop universe is almost like you're running your own business. And actually everyone talks about Citadel and Millennium, but I'm old enough to remember when Stevie Cohen was at his prime and it was called SAC. And then he had all the regulatory issues. And SAC was at one time the biggest of all the pod shops until they had all the regulatory kerfuffle. And they've come back as 0.72. They're a little bit smaller than the other big ones. I mean, they're still 40 billion.
Yeah, it's not a bad comeback.
Not bad comeback. But the biggest out of those pod shops are obviously Citadel and Millennium, who run about $70 billion, which doesn't sound like a lot, but if you think that's 10 times levered. Yeah. And Millennium alone has 6,000 employees. Citadel a little bit less, around 4,000 employees. Why have the pod shops won? It's because allocators like the pod shops because they don't want to take a risk with one portfolio manager that then blows up. They've seen that movie so many times before. And what they want is they want market neutrality and they want good Sharpe ratios. The days of just space chasing performance, someone has an up 30 year and then you allocate to them and then they blow up. Here, you're able to allocate to the fund, and the pod shops tend to be market neutral. They're diversified. In some ways, they've eaten the lunch of the fund of funds. Again, for my sins, I was rereading Barton Biggs's autobiography a couple of days ago, which is called
holiday reading.
Hedgehogging on holiday. Sad guy I am. I'm not sure my 9-year-old kid was impressed with that.
Especially when you were reading it to them.
I was reading Hedgehogging and how Barton Biggs was and. The statistic was Barton Biggs wrote that book before the financial crisis. The stat was that 40% or 50% of hedge fund money came through fund of funds. This is before the global financial crisis. And then fund of funds obviously blew up. They had massive performance issues, liquidity issues, then obviously we had Madoff and so forth. But the big multi-strats, in particular the pod shops, have sort of taken that fund of funds role. So allocators love them because they're market neutral. They're diversified. They have great Sharpe ratios, low, you're looking at, it's not just looking at return, but risk-adjusted return with volatility. So Millennium in particular is famous not for having 20% returns. Citadel has 20% returns, but having low double-digit returns, but with very, very low volatility in the book. So even in down markets. And what you've got with that...
what's been interesting over the last few years, right?
Yeah, and what you've got with that pod shop space is, you'll have hundreds of pods of teams, and it could be one portfolio manager with 5 analysts or 10 analysts, and they're running their own business. The good thing for them is they don't have all the hassle of dealing with marketing and being on the road. They can do what they love, which is basically run money. And the general sales team and the marketing team at the pod shop can take care of client relationships, raising money and so forth. They get an allocation from them. The pod shops tend to be one master fund, and they'll get an allocation of money. And it's not so much client money, but it's almost like an allocation of capital. So it can be, it's levered at the central book, and they run that money. The other characteristics of pod shops is they are hire and fire, and they tend to be brutal in terms of performance. So they're not looking for, we want 25% returns. 25% returns is great, but typically in a pod shop, if you're down 5% with your capital allocated, they'll start pulling capital away from you. You're down 8, you're probably fired.
What's your take on this sort of hire and fire in this sort of space? Because you can understand that it's kind of like football management, isn't it? You're very much exposed to the results of where you're sat, but it's it feels like there's some big numbers that are going out there. And is it the most productive and efficient way of running businesses? Obviously, they're doing all right with the philosophy, but it does feel like something there which could be improved and built into the sort of plays at the most efficient way of running businesses.
I think massively. I mean, the press obviously pick up on the hiring, firing, and it is true. Just numbers-wise, you're just going to hire and fire a lot. So if you look at AUM to employee, the AUM to employee at Marshall Wace is like 100 million. At Brevin Howard will be 30 million, but at a pod shop like a Millennium is the extreme example, will be 12 million because you've just got more bodies there and it's more diverse. So you see a lot more movement of people. But actually, I was having lunch with someone very senior at one of the top 6-7 pod shops the other day, and he's like, Rupak, we actually don't like firing people if we just hired them because we have to pay out some of that guarantee. So actually, ideally, they don't want to do that. So hiring decisions can be costly, as you know. So obviously that doesn't make good headlines, but people are very cognizant about who they're hiring. Actually,
I think it's a really important part about what makes it successful. If you look at, it'd be actually interesting for you. This is gut feel as opposed to anything for me, but I feel like when people are properly invested within that sort of making the right decisions, as opposed to just being so right, let's it's never quite to this extreme. If you think one extreme is let's bring a bunch of people in and hope some of it sticks, and the ones that stick will then cover off all the people that don't at the same sort of stage, through to let's get our advantage through our people, let's get the process in place to make sure that I again think about the sort of data that's involved in some of this decision making, and I feel it still remains a sort of gut-based decision. When you're talking about the opportunity cost running into millions and billions in some instances around that, the whole process of making that right.
I think there's a huge factory that needs to be built there. Frankly. I think it's grown. Remember that this is a new space in terms of the scale of the space. And everyone's seeing Citadel and Millennium's success, and they're able to hire and fire because they have stratospheric pass-through ratios. So the old model of hedge funds are 2 and 20, and obviously some of them are down to 1.5 and 20. The model of a pod shop is you have something called a pass-through. So they pass through all the costs of the managers and most of the costs into AUM and to the client essentially in lieu of management fees. So typically they don't charge a management fee and they get a performance fee. The pass-through at firms like Citadel and Millennium up at 10% a year, which are astronomical. And I think the smaller funds are trying to copy it. They're not able to push as much cost through. And then there's a scaling advantage as well there. And I think you see it on the other extreme. I think you've seen it with Jane Global, which is a fantastic firm. And Bobby Jane is one of the best managers in the street. And I overlap with him a little bit at Credit Suisse. And he's trying to build this pod shop out of the gate. And it's $5 billion AUM, but the AUM hasn't all arrived. And he's got the cost out of the gate. And you're seeing on the other side.
Offices though. I was in their New York office watching Straight Down.
Oh really? Okay.
Well, absolutely exceptional.
Which was fantastic. Well, the money's going somewhere. And on the other side, you've got a firm like Esler, which is, obviously high pedigree individuals, ex-Goldman Sachs, have been around at a variety of big hedge funds. But when your AUM is shrinking and you're struggling, the negative leverage, you've got a fixed cost. It's almost like a fixed cost base there. and the negative leverage. As a result, your pass-through ratios as a percentage start becoming much bigger. At a 2 billion, when your AUM is small. And at a large AUM. So I think there's a lot. The only other thing I would say is it's like the headline transfer fees, and like I'm not defending the astronomical numbers, and I think Paul Marshall summarized it best too. And what do I know? Paul Marshall knows a lot more than me. I think he said a few years ago, I think his exact quote was, there's only one Cristiano Ronaldo, but in the hedge fund industry, everyone wants to get paid like Cristiano Ronaldo, or something exactly like that. Because he was moaning about the pod shops, basically, because Marshall Wace don't have a pass-through ratio, and they're having to compete with these US pod shops for talent. And he's completely right. But sometimes I read these articles, typically in Bloomberg and stuff, and they have these headline numbers. And you'll know better than me, and it's a question for you, though you're interviewing me, is that headline number a guaranteed payment if they blow up in quarter one or quarter two, or is it structured? Because from what I understand, it's much more complicated than that.
I mean, again, without sitting on the fence in answer to this question, which is never what you want as an interviewer to an interviewee, is it? But I think it very much depends on who's negotiated what in the whole process, doesn't it? So there isn't a hard and fast rule of this is how you're dealing with things. But look, as with everything, you're only paying so much if someone succeeds or fails, and if you're removing that sort of failure quickly, then you're recouping some of that overall cost.
Yes.
So there's again, if someone's sat there and negotiating their package, and someone's negotiated it well, there's a bigger cost than if someone's come in there and they've been able to.
But I sometimes wonder if the headline number that gets reported.
The headline numbers are always exactly.
That only gets paid if they perform or they're around for 3 years or whatever.
Looking at it completely the other way, it's you look at some of the, again, going back to sport as for example, and you look at these sort of $200 million salary packages spread over a certain amount of time. And it's the same sort of thing here. There are things there which is an eye-catching number which people will put out there and reports will go through because that's what sells papers. Isn't it? That's what shifts Substacks.
Not Substack. I'm trying to be more thoughtful than that. But I mean, what you see with fintech valuations, I spend a lot of time looking at these fintechs, and what I always find fascinating going into this private market venture capital world is the newspapers, understandably, don't have much information, and they get told a number of a valuation round on this company was X. So N26, which is the German neobank, had a valuation round in 2021 where they guaranteed 25% annualized returns to their VC. So Bill Gurley, the famous venture capital, always says, get a clean term sheet, not a dirty term sheet. And it's basically the terms of everything, he says. And so, but what prints the newspaper is this private company he's been valued at this round. And
it's an absolute shifter, isn't it? That's what you're saying. But and to be fair, if you look back to back end of 21, 22, where money was flowing left, right, and centre, there was some crazy stuff that was going on at that sort of stage. I think right now the industry seems a little bit more prudent around what's happening. And I think the reporting is probably reflecting that a little bit. I want to touch on something you just mentioned there, because I know alongside the sort of writing stuff and this, the passion you've sort of done in there and really interesting things that you've been covering, you've also been doing some advisory work, haven't you? So tell us a little bit about how that's worked for you and what you've learned over that sort of period as well.
Well, I think it's some of the same analytical skills, and just as you're writing for a broader newspaper versus a Substack, you're using similar content, but in a different layer of complexity, and so forth. I've advised anyone who needs any help, I'm out there. I've advised some of the biggest private equity firms on financial market structure in the last 2 years. Specific assets, I won't go into specific assets in this space, but what to buy, what not to buy. Market structure change, and I guess the advantage I've had is I've been an operator at the large-scale level at ICAP, which was a very complex business because you had a voice business, electronic trading assets, or trading platform assets, I should say, and post-trade infrastructure. So 3 different segments, all of which I've advised on in that space recently. And then I've also done a startup stuff. So I've seen this sort of disruption side. So that's been fascinating, and it's just different client base, different and I hate to use a management consulting word, but the Venn diagrams do overlap between all these things, because you just get insights from different conversations. So I'll have lunch with a major pod shop head, and he'll have something, and I'll write something in Substack and think, oh, maybe the broader media will be interested in that, or it'll be the other way around, or similar with the consulting work.
Sounds fun.
Thank you. Yeah, it is.
It is. And so coming back to that, and again talking about the sort of, the research you've been doing about what to invest in, what not to invest in. From that I think affords you this sort of wonderful view of what's working and where people should be putting their time, effort, and money at the moment, because it's not easy to do that, and people want to make the right decisions. And I think it's important to make the right decisions. So if you're looking at it now from a fintech perspective, having been involved from one side and now looking at it and advising, tell me some of the things you think that people can do to make themselves investable at this sort of stage.
I
know I've thrown that at you. With literally no prep
I think
as well.
it's really about. I think it goes back to your moat.
Yeah.
And what makes you different.
Yeah.
Versus and what's your journey.
Yeah.
Because it's a little bit like I could write a great Substack, but no one could read it. But what's your journey to market that content? And it's the same thing with the content game.
Yeah.
What's your journey to market that content? And it's the same thing.
And what's your market? What's the appetite?
B2B enterprise software is very different to B2C.
Yeah.
I find people tend to bunch fintech together.
Yeah.
But like being successful in B2B,
fintech's so broad, isn't it?
B2B and B2C is very different. B2C, you can do different marketing campaigns. I still remember when the Wise guys launched, and they all got naked and with attractive women in the middle of the city, and they did lots of adverts and stuff like that. And they had, and Monzo had this flashy card and stuff like that. Try to sell a product, enterprise software product or a data analytics product into a systemically important bank. And go through that procurement cycle.
It's a different marketing. Isn't it?
A company I advise in the enterprise software space, I remember going to one of their pitches last year and helping them, and everyone was like, "Oh, they thought the customer would be interested in their algorithms and the quality of the algorithms and whether their quant was ill and would be good to present or not." I said to them, "What Barclays care about is what JP Morgan thinks about it." And it's that, it's the same thing we've seen in, it goes back the age-old man, history of mankind and voice broking and stuff like that. There's an element of FOMO even in that.
Yeah.
The FOMO is that no one wants to be first because, it's like people hire McKinsey's because everyone else hires McKinsey's or Clifford Chance. Yeah. So in a similar way, I think it's finding that part. I think sales is very, very different in enterprise software, B2B to B2C.
Yeah.
So you can have a great product, but what's your path to market?
Yeah.
What's the motive of the product, the specific, but what's your path to market? I think is really...
I'm pleased you said that, because I think I 100% agree with you, and I think the failure point of so many companies is just, you one word in the middle of that, which is procurement. And when you're talking about selling to capital markets organisations, it isn't an easy sell. It isn't an easy process.
Yeah.
We filmed last week in here talking about the sales, enterprise sales within this industry, and it's complicated. It's hard. And so to do that, you want to make sure you've got a product that's needed, and I think there's a lot of people who are punting products at the moment that aren't necessarily the things that absolutely inevitably have to be bought right now.
Exactly.
They're nice to have, and if you can get something there.
What pain point is it solving today?
And does it dramatically improve productivity?
Yeah,
massively.
I've been in those pitches where it's like, oh, this will help you by 30%, and they're like, 30% maybe in 5 years, whatever. But the hassle of doing it. Yeah. It's got to be it's got to wow you 10x.
No one wants to be shot at the moment, do they?
Exactly.
Let's finish on this article, because it coincides with release date today. Tell us a little bit about this Brevin story and your interest within it.
So I've written a lot about the pod shops, and I've written a lot about some of the new star managers. Arini is I think a fascinating manager, credit manager that's growing, QRT, SquarePoint, and so forth. Brevin have tried to sort of move from the single manager into the multi-manager. I mean, Alan Howard, we all know his legend, and the story of his bitter breakup with Chris Rokos. And the thinking of is that they had a lot of positive coverage recently, and they deserve a lot of this coverage, because Brevin went from being the biggest hedge fund in Europe with 40 billion of AUM to in 2013 to having 6 billion of AUM in 2018. It was almost like, does he turn it into a family office? Yeah. And now they're back at 30. And they've got Middle East money coming and so forth. But my thinking is that Brevin is in a much better place than it was 5 years ago, but is it winning? And I think they're stuck in the middle ground. It's almost like the active manager that's stuck in the barbell between the hedge fund and alternatives investing and private equity on one end and the passive fund on the other end. And in a similar way, you've got these pod shops that are able to pass through 5-10% of AUM every year in fees and hire thousands of traders. And it's not just Citadel Millennium, there's Balyasny, there's Point72, there's Jane Global, there's Hudson Bay, there's Veritian, and there's a variety of these other funds that are in that pod shop elk. And on the other side, you've got a fund like Rokos. Rokos tried to be a little bit of a bigger firm, but there was performance issues. Then he went back to, I'm Chris Rokos. And he just ran the money himself, essentially. And he put up some massive numbers. The problem with Brevin is that they don't have a Chris Rokos anymore. Alan, from what I understand, from the press coverage at least, stopped really running material money 4 or 5 years ago. So out of the 30 billion of AUM, even in the master fund that's 11 billion, he runs a very, very small portion of that. You don't have that background. And then to build a pod shop and compete with these guys is difficult. And on top of that, they've had performance issues. So the macro space, I mean, Brevin has done very well in the last 5 years, but they've had a massive tailwind. And that's one of the things I felt that some of the press coverage hadn't picked up in the last couple of days. It was a terrible world for macro managers from about 2012 to 2019, or not 19, maybe 18. And then from back into 18 to now has been the golden age of macro. You had 2020, you had 2022, you've had all these moves. Caxton, which is perhaps the oldest one of the oldest macro funds in the world, still around, troughed their AUM at 4 billion in 2018. They're up at 14 billion today. That's Caxton is Andrew Law in Mayfair. They've increased their fees. Rokos is doing well. The systematic funds in macro are back. Pure Alpha, Bridgewater is up 15-20% this year. DE Shaw's up 30-40% last year or two in their macro fund. That's a quant fund. So you've got on one hand the pod shops that have got very good performance, but this almost unlimited amount of money. And on the other hand, the macro funds are doing well. And Brevin are sort of stuck in between. I think the master fund is basically flat over the last 3 years. They've had 3 flat years, roughly, if you look at it, at a time when all these other funds have done very well. They have done very well in creating something called a Pure Alpha fund, which is almost like a pod shop fund. So they don't have a pass-through like a pod shops, but they have a partial pass-through of costs. And that fund has grown from 0 to 12 billion. It's the brainchild of Aaron Landy, the CEO, who was the chief risk officer before. And it's grown nicely over the last 6-7 years. Again, the problem is that you've had some performance issues. They were flat for the last 2 years, and this year they're up 5% against the backdrop that these other guys are doing much better. And then the other thing they've tried to do is they've tried to seed single managers within the Brevin elk. So you've got a master fund, which is a third of assets, the Pure Alpha sort of pod shop-like fund, but struggling to compete with those pod shops in terms of cost, in terms of infrastructure and so forth. And then they've tried to seed some of their single star guys into single managers. And that has kind of flopped. There's been one in Singapore that's been successful, but they've largely flopped. And as you can imagine, performance is king. And without the excitement of performance fees and the power of performance fees, you have less to play with.
And what's the view of where it heads for them?
I think that's the challenge. I think they've done amazingly well to get from 6 billion to 30 billion.
But not all 30 billions are made the same, as you're saying, right?
But not all 30 billions are the same. They have cut fees on some of their funds to get that. They want longer duration capital, 3-year, 5-year cut. That's the trend in the hedge fund industry. They all remember 2008. All the pod shops are doing it. Those famous macro funds are doing it. But they're able to they have more demand than they have supply. So they're able to increase fees from 2% in 20 to 3 in 30, and also increase their lockups, or increase their pass-through and increase their lockups. Whereas Brevin's having to cut fees, again, going by some press coverage they've had, the press talking about reducing the fees in the master fund to 1.5% for 3 years, to be able to redeem over 3 years. So not locked up for 3 years in total, but to be able to redeem over 3 years or 5 years, which are materially weaker terms than the competitors. The Abu Dhabi thing is fantastic news, but Brevin and many of the hedge funds have looked at that golden piece of land and looked at all the promise of golden money coming out of the Middle East for a while. And I mean, the last time I checked, Brevin had 100 people in Abu Dhabi. I don't know if that's
very
true.
Quickly, wasn't it? Yeah.
So that's a massive cost base they've built up. And I assume they built up in anticipation of gold coming. And so they built up a big cost base in anticipation of this money. Typically, the sovereign money comes at lower margins. I don't know the margins on this money, but typically, everyone assumes that there's free money in that part of the world, but they negotiate as well.
Yeah.
And given Brevin's performance issues, I'm pretty sure they would have negotiated hard on the other side.
So an interesting picture that we see.
Well, the other trend you've got, Toby, is really you've got the hedge fund industry and the HFT industry clashing.
Yeah.
So HFTs used to be Michael Lewis, Flash Boys, trade milliseconds, billion times a day. Hedge funds more longer term. Hedge funds are becoming more short term, pod shops, trading. That's the hedge fund dominance, more levered. HFTs are moving this way. Jane Street is the biggest of them, but they were never really an HFT. But they're more like a hedge fund in many ways. They punt, they take big bets. But even the other big HFTs, many of them are moving this way.
And they've been talking a lot about quality over speed is the sort of thing which I've been talking about in that space, right?
Hudson River is a prime example of it. They just had a massive quarter. Last quarter, Hudson River Trading, which most of your viewers probably haven't heard of as much as someone like Citadel Securities, made more revenue than Citadel Securities.
Yeah, it's incredible.
And most of it was from doing mid-frequency stuff. So you're seeing a clash between, your square points and your QRTs and so forth, and your pod shops who are more short-term, and the quant stuff is more short-term in the hedge fund space, and then these HFTs, because that trading out, I saw it on BrokerTech and EBS, I've lived that for a decade. The margins got crushed. The margins on HFT high-frequency stuff got crushed.
So I could be talking about this for you for a long time, and I know we've had the wave from behind the camera. So let's finish off by talking about you and the Substack. Like I say, there's been I always look forward to it coming through. I look forward to your writing. I think you're doing a great job at the moment. So if we think about what people can get from it, who should be looking and following, what can they expect to see, what's exciting to coming up on the
So the Substack, if you're interested in hedge funds, fintech, and financial market structure, exchanges and so forth, I think this will be relevant for you. I think we've got about 3,500 users at the moment, or subscribers. Most of those are people at hedge funds and banks. So we've got the founder and CIO of one of the biggest hedge funds in the world. We've got the head of investment bank and one of the biggest investment banks in the world. And on the other side, you've got hundreds probably over 1,000 people at Citadel, Millennium, and the big hedge funds, from everyone from portfolio managers to traders to business development staff. So if you're not reading it, probably your colleagues are reading it.
And get involved. Listen, it is great fun. It's always a pleasure to have you on the show. Thanks for coming on board. And thank you all for watching. We will see you soon on the next episode of FinTech Focus TV. Thanks a lot.